Just want to start this session with a comparison of saving versus investments. To me, in my mind, it's really investing in deposits, earning a kind of fixed return versus going for higher returns, which would largely mean riskier asset classes like equity. If you go back to March 2014, India's domestic equity ownership through retail, direct and indirect, was less than 20% of deposits. That number today is almost 45%. There's a big shift. Part of it is new money, as Nilesh Bhai explained, making mutual funds in a very simple way available to investors to save. And of course, part of it is returns. The returns in the markets have been higher than returns in deposits. Now, coming to the question of transition, and this sort of explains the word transition. Hopefully this transition actually creates more wealth and creates more wealth for more people. And the transition should not be creating wealth for a fixed set of people. And that is important. And to do that, having a very long-term perspective to investing is very important. Every market will have traders and every market will have investors. And it's very important and imperative that for traders, we have strict rules, especially in speculative investments like options. There are strong rules from a custody perspective, from a margin perspective, which protects the markets and the market infrastructure. And for long-term investors, there is a lot of education and continuous education, which we are anyway seeing being done by the regulators. And in addition to that, I think we always, as a market participant, as a merchant banker, I always get this question on speculation, high PE multiples, high valuations. And the answer is not simple, but frankly, there'll always be excesses in the market. And one has to have a look-through view over the cycle. And all these excesses kind of get washed away and sanity comes back. And India is doing so well, and just the growth in India is so strong. It is very difficult to control these excesses. And the only way one can try is good regulation, much more investor awareness, and if required, strong controls on financial market intermediaries, as well as strong control on media, as well as digital, where you could have mis-selling and a hell of a lot of mis-selling. And eventually we can do, we can have a lot of these measures, but investors ultimately will only learn when they experience a bear market, and that's the unfortunate truth. As I said, one has to look through the cycle. Now, coming from this transition and seeing what we are seeing in the primary markets, I'll give a very different take here. I think India's primary markets have come of age, and I'll make a few points here. In my 27-year career, I've never seen the strength of domestic money in the primary markets that we are seeing today. Every single IPO, every single transaction that we do today is led with domestic investors, whether it's mutual funds, family offices, insurance companies, but they are leading those transactions. This was not even possible pre-COVID 5 years ago. Till we didn't have large foreign names, it was impossible to raise equity. And this is a game changer, and I think this continues. Second point is the breadth of the market. We've always had kind of a cyclical India in the capital markets. You would have the financial sector doing very well and issuing capital. You would sometimes have metals and mining, depending on the commodity cycle, or technology and IT services. Today, when we see our business, we see a huge amount of breadth. It seems like every industry is doing well. Every industry requires capital for growth. And it is happening across technology, IT services, pharmaceuticals, financials, consumption, across every sector, which is a very positive sign. Third is we are seeing the emergence of private equity. In fact, in many of the cases, in terms of capex and investment, private equity is leading the charge over corporations. And this is the new form of global capital, which India is being able to attract. And a very robust investment market and a robust equity market is very important for this continuous flow of private equity capital into the country, because they need to exit. These investors don't have a 20 or a 30-year view. They are not corporations owned by families. And they have a 5 to 7 year view. But when they get exits and they make money on these exits, they tend to invest even more money. So that's another very important trend. And the last point is the emergence of families selling, and a lot of secondary sales and offer for sales, where families are diluting holdings in their companies, taking money off the table. And I'll give you a statistic. Year to date, the OFS, the offer for sale number is 87,000 crores. There have been years in India's capital market where primary market raising has not touched 87,000 crores, but year to date in 8 months, we have seen 87,000 crores of selling, and a large part of that is being systematically invested back into the equity markets. So there is a shift in capital allocation from companies, from business owners, and again, this is a positive trend long term, and augurs very well. So these were my comments both on the transition as well as markets.